Hey guys, it's Joe Boyles here to talk today about estate planning and taxes. So it's a common question that clients will have coming in as to how taxes will affect what their beneficiaries, what their family receives when they die. The good news, and I tell people this out of the gate, is that the vast majority of people in America do not pay federal estate taxes, and no one in Florida pays state estate taxes. So the cutoff for estate taxes federally is $12.92 million giving away per person. That means that a married couple can double that. The ability to give away for a married couple nearly $26 million means that there are very few households that are going to have to deal with that issue. This is actually an increase over what the IRS allowed last year. So people that do with much higher estate plans, we do have things that we can work on them with to avoid some and possibly eliminate the possibility of paying estate tax. There's also the ability to give each year $17,000 per person in a gift that does not have any tax consequences. That's during your lifetime. You can give each person $17,000 per year. A married couple can give each individual double that. This is an increase over what was allowed previously as well. I believe last year it was $16,000. So that's a way to lower your estate if you are potentially bumping up against that taxation amount. The ability to give these gifts also means that a married couple could give each part of a married couple, each spouse could give an individual the full $17,000 gift. They could also give that person's spouse, each person could give that person's spouse a $17,000 gift. So as you can see, that money, if you give it to spouses and their children, also to grandchildren, that money can come out of your estate and lower that potential taxable estate if you are bumping up against that. Another thing to take into account is that once you pass assets to your heirs, at the date of death, the potential gains that you could or your beneficiary could incur by selling a highly appreciated asset like a stock or a piece of real estate, the basis of that, if you consider this is what you buy the property at and this is what you sell it at, typically you pay taxes on this area in the middle. When you at death, that basis, that tax rate that you're judging that gain from goes up to date of death value. And so from date of death, there's no gains and no taxable event to your heirs, even if they inherit from you a property that's gained a lot of value during your lifetime. So those are that's some good news for taxes. You don't get that much. If you'll come back sometime soon, we'll talk more about powers of attorney, wills, and trusts.